Good evening, everybody. Welcome to today's investor education webinar on how professional investors identify quality companies, a simple checklist for retail investors. This session will be taken by Mr. Sunil Singhania. To introduce Mr. Sunil Singhania, Mr. Singhania remains a leading figure in Indian asset management and is the founder of Abacus Asset Management Private Limited, which he established in 2018. With nearly 30 years of experience, he is a chartered accountant and a CFA charter holder. He served as a chief investment officer from 2003 to 2017 equities at Reliance Nippon Asset Management, Life Asset Management, which is now known as Nippon Life India Asset Management, and managed around USD 11 billion in equity assets. Under his leadership, the Reliance Growth Fund grew over 100 times in less than 22 years and earned global recognition. He also led global head equities at Reliance Capital, overseeing assets around $60 billion. Mr. Singhania was the first Indian appointed to the CFA Institute's Global Board from 2013 to 2019 and chaired its investment committee from 2017 till 2019. Mr. Singhania has contributed to India's financial sector through roles in SEBI's Alternative Investment Policy Advisory Committee, which is also known as the APAC, and has been a founding member of the Association of Portfolio Managers of India, which is also known as the APME. His career is marked by leadership in fund management, global finance governance, and advancing investment professionalism in India. Now, to tell you briefly about NISM, NISM is the capacity building initiative of SEBI, and the institute conducts a wide range of capacity building activities at various levels with the aim of improving quality standards in the securities markets. At NISM, we work in five broad areas, which are the long term and short term academic programs, the certification examinations, the e learning programs, the training programs, and the investor education initiatives. Without taking much of time, I would now request Mr. Singhania to please take the session. Thank you, sir.
Thanks everyone for joining. I will share a little bit of my screen. Thanks a lot for joining in. It's my pleasure to give my little bit of perspective and share my experience of equity markets. And obviously it's always nice to connect with budding professionals, some existing. I'm very sure those who are aware of it. So, as the topic is how to identify, opportunities, I would just like to basically highlight of what we try to do at Abacus. Obviously, we will have time for some questions, but, I think it will make sense if it is a little bit more engaging. So, after I finish, more than welcome to answer any queries we have. So as you might be aware, equity markets are always, volatile. They always move up and down. They're never constant. And from time to time, different factors keep on impacting the equity markets. Obviously, there are some company-specific factors, some sector-specific factors, some economy-specific factors, and then there are international factors. And all of these factors can be both fundamental in nature and can also be news flow based. So in case there is some geopolitical issue, some event like COVID, which happened, tariffs, which is more like an economic factor, currency movements, cross-sector movements, and so on and so forth. And as a result of which, markets always keep us on toes. So if you actually look at this chart, and you see that over a period of last 25 years, markets have definitely moved, up. But in this movement, there have been so many instances where markets have given deep corrections. Whether it is 2008, which was Lehman time when the market almost halved. We have had multiple other issues. You had the quantitative easing in 2013, Brexit, which led to a minor fall in the market. You had COVID, which led to, almost a 30% fall in very, very quick time. And very recently, the imposition of tariff by US on the world and particularly India also had almost more than a double digit kind of corrections. And I think in amidst all this, very, very clearly, a diversified portfolio has a lesser impact than some of the other thing. And our view is that obviously for an investor who's looking at markets, for the first time or doesn't want too much of volatility at the same time wanting to create alpha, I think the best way is to have a diversified flexi type of a portfolio. If you also look at how markets behave from time to time, this whole narrative about large cap or mid cap or small cap is for real, frankly. From time to time, we have seen different segments of the market do better. So if you see, when the markets recovered post COVID, I think all three segments of the market, which is large cap, mid cap, and small cap, did better. But obviously, in 2020 and 21, mid and small cap did significantly better. In 22, we had a minor correction. I think Nifty did not fall at all, but small caps fell very, very sharply. And then again, 23, 24, when the risk on happened, markets moved up by a bit, but the mid and small cap moved up quite significantly. However, at any given point of time, and these kind of things happen, there is a valuation mismatch which happens. And obviously, in 2024, mid and small caps became a little expensive. As a result of which, in 2025, what we are seeing is that Nifty has moved to an all-time high. The returns have been more modest at 6-7%. But mid and small cap, even the indices have lagged the large caps. And individual stocks have been at a significant correction compared to large cap. I think I'm giving you this backdrop because, as I said, from time to time, different segments of the markets will behave in a different way. What we have also seen is that styles also work at some point of time, different styles. So, again, in 2010, as I mentioned, it was a time of low volatility, quality, mid caps, small caps, alpha plays. And the narrative as we move forward has kept on changing. When now in 25, we are seeing low volatility, which was underperforming 4 out of the last 5 years, has outperformed. And alpha, which was so dominant in 4 out of the 5 years, this year has given a negative return. So, not only does the size based, performance differ from year to year, but the style based performance is also very consistently differ from year to year. And so is the case with sectors. So if you again see, in 2020, pharma did very well because obviously in COVID, the demand for pharma products shot up. IT did very well. And now on the reverse side, in 25, we are seeing IT as the worst performing sector, largely because one, growth has slowed down. There is a threat of AI. And also now with this rhetorics of anti-H1B visa and anti-immigration, I think IT has not done well. Similarly, banks, which were struggling this year, banks and financial services have done well. So sector movements also have differed from year to year. So, one, the size-based movement, which is large cap, mid cap, small cap, have differed year to year. There has been volatility. Then you had style-based, whether momentum or quality or alpha does well or not does well. And then you also have sectors where there is a huge movement. And as a result of which, as I mentioned earlier, I think one has to be very sure that in the near term, you will have a very wide variation in multiple factors, whether it is size, whether it is style, or whether it is sectors. And in that sense, if as an investor, one is focused on doing things which we are confident of and which are fundamental based, at least from our side, we are very, very fundamental based, that would give you the confidence of sticking around for a long period of time, which is how wealth is created. A little bit on what we do at Abacus, and obviously that will give you a little bit of perspective of how we are basically looking at stock picking or looking at stuff. So one is we have a framework, which we call the MEETS framework. Now, why is a framework necessary? See, India is a large economy and India is a large equity market. We have 6,000 listed companies, almost 1,500 investable companies, which are of some size. And obviously, it will be impossible for anyone to track 1,500 companies. So one is a framework if you have, it allows you to shortlist companies which you can focus on. The other thing is it also ensures that you make less mistakes. So when you have a disciplined approach, you have a framework, it also ensures that mistakes are minimized. And equity returns at the portfolio level are a combination of picking good stocks, but also ensuring that one makes less mistake. And I think amidst all this, we believe that having, as I said, a framework will improve the chances of ensuring that you are, invested in good stocks, but also ensuring that you make lesser number of mistakes. And I think this is where this framework comes in. So what is this framework? As I said, it's called the MEETS framework. MEETS M, which is management. Obviously, every investor would say we invest in good management. What is the definition of good management? I think good management can be one which is very educated and so on and so forth, speaks well. But from our perspective, being a very number and fundamental focused fund house, from our perspective, good management is discipline as far as capital allocation is concerned. So we typically look at companies where incremental return on capital employed is decent. Typically, we look at companies where there is a minimum 14 to 15% return on capital employed or return on equity. And capex is fine as long as the incremental return which will be generated out of the capex is at least 14 to 15%. We also look at things like perspective on minority shareholders, so distribution comes into play. And business errors are fine. Deliberate errors are not fine. So our definition of good management obviously is discipline in terms of capital deployment, and there a minimum ROC/ROE of 14-15% is the need of the hour. The E is the earnings, but see, equity investing is all about investing in a growing asset class. I always say this, that if you buy 100 grams of gold, even after 20 years, it will be 100 grams of gold. It's not a growing asset class. The only way you make money is by price appreciation. Equity, on the other hand, is investing in a business. So it's a growing asset, and you will make return only if the asset grows. So we typically look at companies which can double profits, ideally in 4 years, maximum of 5 years. And our view is that if the profits of a company double in 4 to 5 years, then the probability of the valuation doubling is very, very high. And therefore, we look at companies, as I said, where profits can double ideally in 4 years, a maximum of 5 years. The second E is very important in the current context: event trends and disruptions. We are in a world where disruptions are the order of the day. So the way we are meeting is online, the way we study, the way we consume stuff, the way we order stuff, the way we entertain ourselves is all changing, and in a disruptive world, gone are the days where you could invest something for 30, 40 years and forget about it. Now, every business, every product is prone to disruption, like newspapers, the current generation does not read newspapers, and as a result, the advertisement revenue is shifted to the digital platform. Or even entertainment, gone are the days of Star, Z, Sony, most of the entertainment has shifted to the Netflix and Amazon Primes and the Hotstars of the world. And even if you look at passenger vehicles, particularly globally, Tesla trades at 200 PE multiple, but BMW and Mercedes and Volkswagen, they are all very, very good brand names, but they trade at PE multiples of 6 or 7 because there's a threat of disruptions. So typically, if you would have studied, market price of a stock is equal to EPS into P. EPS is the earnings, P is the perception. And I think if P falls, then even with the same earnings, your stock price can fall. And I think these are perceptions. Perceptions rise and fall based on the outlook going forward. And therefore, disruptive, I would say factors for any company is a must before one looks at investing. Any company prone to disruption will always be at a risk of the P multiple contracting. T is the timing. We can't time the market for sure, but we definitely believe in the theory of mean reversion. And that's why we don't chase momentum. Our view is that, obviously the best company is not necessarily the best stock. And therefore, one does not need to get swayed by just the perception that it's a good or a quality company. If it is priced to perfection, then one should wait. And the classic example is the last 4 or 5 years where a lot of these quality, consumer companies and so many other companies, which are great companies, but which were priced to perfection, have given negative to no returns. And the list keeps on increasing. And again, as I said, not because they're not great companies or they don't have great businesses, but because they were priced to perfection. The last is the S. India is a country which is having the potential for a lot of sectors and companies to grow fast. I think there will be some companies which will have a competitive positioning, consistent, faster growth of profit, a unique moat. And there, despite our value focused consciousness, we will have to, pay a slight premium. So I think this is the core or heart, at least as far as Abacus is concerned in terms of criteria for the stock selection. So just to recap, minimum 14-15% return on capital employed, profit-making companies where profits can double in 4 to 5 years, a little bit of focus on value in relation to the growth outlook of the company. And in some cases, we are fine to buy expensive companies as long as the growth is significantly higher. Actually, this is the core of what we do. Then there is a complete investment process. I think this is our investment process, but as budding investment professionals and as existing investment professionals, I'm sure all of you also have a very detailed investment process. From our perspective, as I mentioned, 1,500 companies worth investing. We run them through the MEETS framework. And when we run them through, around 450 to 500 companies come out. And out of which almost 400, 425 companies we track internally with our research team. We have a 20-member research team because one fundamental analyst cannot do more than 30, 40 companies. So we have, almost 10 lead fundamental analysts tracking around 400, 425 companies. Where they have detailed model, company meetings. These are all very, very necessary. When you build your own model, you know what the numbers stand for. You are able to question yourself. You are able to answer queries. And, when you do work yourself, you understand the contours of, contribution, gross profit, EBITDA, fixed cost, variable cost. And that is how the confidence on the work gets strengthened. Once we have done that, I think every analyst has a few recommendations, and based on that, we have a very strong view on almost 100 companies, and that is where we then put it into the portfolios depending on the objective of the portfolio. So, if it's a Flexi-cap fund, then we will have weightage across large, mid, and small. But if it's a mid and small cap fund, then obviously the weightage will be only in mid and small cap. And that's how the fund manager will create the portfolio. So one is the MEETS framework, which ensures that, you concentrate on few good names and also make less mistakes. And then you have a process to ensure that what we have selected also runs through a proper process so that there are no loose ends which are left. Risk, obviously, one has to manage. One can always go wrong, but if you have managed your risk properly, the chances of going wrong also minimize. And even if you go wrong, the drawdown or the loss which you would end up making will also be minimal. And both are very important in portfolio management or in creating an investment sort of a portfolio. So if you want to generate returns, if you want to fill a pot, you don't only have to pour water, but also ensure that there are no holes where water can be drained out. So, pouring water is buying good companies, and plugging the holes is basically your risk management and ensuring that the framework is strong to ensure that you make least mistakes. Company risk is almost, entirely through meeting companies, having detailed modeling. There is no substitute, we say, for this. Balance sheets are very, very important document because presentations are made, annual reports and balance sheets are derived. You can't make them. It is a derivation of how the company has performed, and therefore cash flows are also very, very important. You also have to keep in mind the market risk. Many times, even if a good company is there, like what happened in 24, the market became very expensive, and there was a lot of headwind for the market from slowing down of the economy as well as companies being little expensive, which is a combination of valuation risk and market risk. Then, from a portfolio perspective, you also have to manage, liquidity. You don't want to have a very disproportionate weight to companies where volumes are very low. And therefore, I think not only one has to be cognizant of the size and sizing which one does, but also be very clear that you don't want to frequently get in and get out because, to buy if you pay 5% more and to sell if you have to sell 5% lower, then most of your return will just go into impact cost. So I think that both the size of the company, the sizing, as well as the duration of your investment are all very important to manage liquidity. And then there is also the concentration thing. If you like a company, I think at least we are not in the camp of saying that, okay, let us only have 2 or 3 or 5 companies in the portfolio. We like a little bit of diversification because however strong your view might be, it is always possible that 1 or 2 companies might not work the way one had expected. And I think to that extent, we also have to be cognizant of the concentration risk. So I think just to recap, framework, a proper process, and a risk matrix. I think all three will ensure that returns are not only good, but they are also consistent. What is also important is what not to do. So, we all get very fascinated by what to do. Equally important is what not to do. And this is what we have in our framework, which we call the 4 Cs. So one is chase momentum. I think chasing momentum is fun. I always say this, if a train is moving, everyone wants to jump into the moving train because it will move ahead somewhere. Our view is that, if you jump in any train, it might lead you to a destination where you don't want to go. And therefore, we will not be investors only because a stock is moving up. We would like to be more fundamental based rather than momentum based. We would like to jump in a train where we know is going to take us to the destination where we want to go, not to any destination. Second is churn unnecessarily. Again, this is fun. Buying, selling, everyone wants to be active. And we end up, only benefiting 3 people. One is the brokers because of brokerages. Second is the government because of STT and exchanges. And third is again the government by way of short-term capital gains or trading profit. Eventually, I think these all eat into your returns, and therefore churning unnecessarily is a complete no. Obviously, if you want to sell something because of strong reasons, one should do it. But frequent buying and selling is only going to eat into your returns in a very, very major manner. Third is copy and mimic. Many times we get sucked into a company because of the fact that someone else has bought it. So, these someone can be well-known names. So many times you read in the newspaper that so-and-so has bought and then everyone piles in. It can also be peer pressure. Your friend has bought it, your neighbor has bought it. So you feel that if you don't buy it, you will be left out. and therefore you buy just because someone you know has bought it. I think again it's a disaster because this is based on borrowed information or borrowed knowledge. You will never know when that person sells out, and you might be left in the lurch. And last is fractured balance sheet and credit risk. Companies where balance sheets are completely fractured, we would tend to avoid it. Again, I've seen a lot of lure from retail investors to buy companies which are 5 rupees, 10 rupees, 2 rupees, 15 rupees. They have very, very shitty balance sheets. And more often than not, that capital is going to become zero. One off, you end up making some returns, but more often than not, these companies end up in the dustbin. And therefore, we would definitely avoid this. So, along with what we do, which will be a function of our framework and the process and the risk, it is also very important what we don't do. And I think this is something which one should never forget. Now the call is, what do we do? Top down or bottom up? How do we pick up? So, what is the starting point? Obviously, the starting point has to be, you will have to have a view first in the country you're investing in. So if the view on India is positive, the view on the economy is positive, then only your view on the corporate side will be positive, and therefore you will invest in equity. But how do you, within the equity or within the overall corporate world, figure out things? So obviously, you will after having a view on the economy, you will say, okay, the economy is doing well. What sectors are looking good? So say financial services is looking good because RBI has injected liquidity or cut interest rates. So that becomes your hypothesis, and then within that you go and see now which among the financial services, whether it is the lending stocks, banks, private banks, public banks, NBFCs, capital market plays, insurance, what could look good. And I think that is where the bottoms up will come into play. It is also, important that when you are doing or when you have a very, very positive view on themes, like, renewable is a great theme, data center is a great theme, semiconductor will be a great theme, electronic manufacturing is a great theme, or some of the other upcoming themes which might come in, which is hydrogen and so on and so forth. I think these are very important for really, really long-term stock picking because themes take time and one has to be early. If one gets into themes after it has already become very popular, I think the chances of making disproportionate returns are very, very less. And same way on the risk side, I think one, obviously macros have to be in your favor. If you don't track that, you will fall into a value trap. And value trap is something which is, again, very important because, you pick stocks based on the fact that it's cheap, but it might be cheap for a reason. And if degrowth starts to happen, you will never be able to get out of it. And obviously, the trends and cycles will be similar to thematic. But again, at least our view is that focus on companies where at least there is positive earnings. So I think this is what we will like to share on the top down and bottoms up side. Which approach is better? I think everyone is very different. Every investor will have a different strength and a different way of thinking. I don't think all investors should think alike. Otherwise, there will be no trades. Whenever a trade happens, there is one buyer who's positive on the stock and one seller who, at least in the near term, wants to exit the stock or is negative on the stock. And that's how trades happen. So there will never be one size fit alls. One will also have to do a lot of work based on what works for you and what you are comfortable with. I think as a starting point, we always say that, suppose if you resonate with what we say. So it's very simple. You just run a filter, companies which have an ROC, ROE of at least 12, 13%. Obviously, once the ROC is at 12, 13%, the company will more often than not be positive. You add filters at what is the profit growth expected and what is the multiple. I think at least it would be a good starting point, and then you can just go deep study which sector are looking good. Again, sort of shortlist based on the sectors and so on and so forth. So I think it can be a good starting point. Uh, from a style perspective, again, it will depend on what your objective is. I think if your objective is long term, you can be more fundamental based. If your objective is tactical or short term, obviously you would like to play momentum to a bigger extent, or very, very near term triggers also one can play if your horizon is short term. Uh, Market conditions also will determine that. I think, for example, in an interest rate reducing cycle, there might be some interest rate sensitive sectors which might do well, and vice versa. In a scenario where currency is weak, for example, now there might be some sectors which might look better, and some which might not look better. When tariffs were announced, obviously companies which were or sectors which were domestic focused looked better than sectors which were more export focused, particularly to the US. So I think that would again be determinant on your style. And last but not the least, what are you trying to achieve? So if you're a professional portfolio manager, then what is your mandate? Whether it's a small cap, mid cap, thematic, there are some thematic funds who will invest only in particular sector like a financial services or an infra, or now there are defense funds and manufacturing funds and so on and so forth. So I think your approach will depend on your comfort, on your risk appetite, and also on your objective. At this point of time, our view is that Flexi-cap is the way to be, and that's why we've launched a Flexi-cap mutual fund also, which is starting on 8th of December. But our view is that in a scenario where too many factors, fundamental as well as non-fundamental, domestic as well as global, are determining short-term market movements, it is always better to have a flexible style where you can move between sizes, which is large, mid, and small, between styles. You can have a value as well as an alpha play, as well as sectors, and it will be a very diversified kind of approach. And I think this is the benefit which you have. What should you have in your checklist? Very, very simple thing. I think business quality, what is the business offering you? So one is the scale of opportunity has to be huge. If the business is small, then the size of opportunity already is small. So company will never be able to grow disproportionately. So the size of or the market opportunity has to be really, really large. Within that size, what is the competitive moat of the company you are planning to invest? Whether the company has the capability, has something extra where it can not only maintain its market share, but also grow the market share. I think if both of these happens, where the market is also growing and your market share is also growing, you have a winner in your hand. And that is where the third point is the market share trends. And as I said, profit doubling, tripling potential. If the company grows the profit, then there is very, 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 very small probability that you will lose money. Because ultimately, as I mentioned earlier, investing is becoming a partner in a business or investing in the business. And if the size of business grows, obviously the value of the business automatically will grow. Evaluation of management, I touched upon it when I described you the MEETS framework. Track record, the old track record. I think capital allocation, we always focus on capital allocation. What are we basically putting into work as a management into the business, and what will we derive out of it in terms of IRR or return on capital employed and whatever you see. And obviously, communication is very important in good times and bad times. Even in challenging times, if the management is very transparent in communicating the facts, very transparent, very approachable, does con calls, has detailed presentations, I think it all adds to building the confidence. And as I mentioned earlier, market price is equal to P into EPS. EPS is profits, but P, the perception, is a function of even transparency and communication. And I think that becomes very, very important. Third thing is earnings quality. It is one is the number of profit, what is the profit the company makes. And the other is what is the quality of the profit which the company has reported. So if the profit is just getting converted into inventory or debtors, and there is no cash flow. And I think again, cash flow becomes very important. See, we are okay with capital or capex as long as the incremental return on capital employed from that capex will be decent. But just doing capex without incremental return again is going to lead to a negative cash flow. So that becomes very important. Second is the profits are whether they are structural or cyclical. You always have cycles. Like for example, paper companies. They had a phenomenal 2022 and 23 and 24. But those were not sustainable profits. And therefore, you cannot give a PE multiple based on your peak cycle profits. So one also has to be very clear whether the profits reported by the company are structural or cyclical. If they are cyclical, then you will have to discount it, taking into account both the good and the bad cycles. And last is one has to have reasonable expectations. I have seen particularly when companies come in for IPO, their past growth rate would be 10-15%, but their projection for future growth will be 30-40% because they are here to sell. And therefore, we have to be very, very clear that, these high or unreasonable projections, whether they are going to be achievable or not. And if they're not going to be achievable, I think the outcome is not going to be great. And there are so many companies which are listed recently. Some of them have definitely done very well, but a lot of them post-listing have not performed to the way they have guided. And the outcome to that extent has been very, very poor. One, we also have to identify what is going to cause a positive catalyst for the stock. See, the best thing which can happen is if you pick a stock where earnings grow and the P multiple also grows. Again, taking the same example, market price is equal to EPS into P. If the EPS doubles with the P remaining same, the stock price will double. But imagine if the EPS doubles and the P multiple also doubles, the stock price will become 4x. That is how you will make a multi-bagger return. And what kind of catalyst can drive? I think regulatory changes, both positive as well as negative. So if you look at online broking companies or mutual funds or even stock exchanges, when COVID happened, the regulator changed the guidelines and complete online onboarding was allowed. And I think we have all seen how the number of investors, traders have more than 20-30 times grown. And that is how this whole ecosystem has become so popular and so profitable. Then there can be some new product launches. I think it happens in pharma companies. It happens in a lot of other companies where an existing company introduces a new product. And if you're able to identify that, track that, there is a winner in the hand. Recent example can be drugs like Ozempic or Monjura. Globally, Lilly and all have been beneficiaries. Even here, some of the companies who are in that GLP-1 segment have benefited out of it. Then there is a market re-rating. If you are able to buy companies which can sustainably grow profit, the P multiples will expand. The companies will grow, the market cap will grow. From small cap, the companies will become mid cap. From mid caps, they will become large caps. And as the size of the company grows, there will be institutional investors who will also be looking at it. So when you invest in a smaller company, typically you should get it at a lower valuation. If it grows, then the larger funds will also start to look at it. And the last is the disruptive trends, the new age businesses. I think people love them, investors love them. Again, if you're able to spot a trend early, like EMS was a trend which if you would have spotted early, companies like Keynes and Sirma and Dixon and all listed at such low valuation, the trend was great and the opportunity was huge and we all know what has happened. So I think to identify some of these catalysts also become very important. We are very value focused, so valuation and timing becomes very important. I think good companies, good trends are good, but they might not be great investment opportunities if they are priced to perfection. And I've given you the example of some of the FMCG companies. Recently, also there have been companies like last year, everyone was talking about railways, and now suddenly you have such a big correction in railway stocks. Similarly, in water-related companies, we have had great correction and so on and so forth. So one has to be very clear of the price you are paying for the growth which is likely. And I think that is very important. As I said, one should learn to say no. Patience is very crucial. Don't get sucked into buying something just because the price is moving up or because everyone is talking about it, if it is priced to perfection. Also, compare P's with the global peers. Recently, there was a company which Whirlpool, where the parents also sold their stock. And we have seen how the price has corrected over the last 1 year because the parents' valuation were significantly lower than the domestic valuation. So I think this is also something which has to see. So just to end, I think these are some of the things which one has to keep an eye on. I mentioned all of them in some or the other manner, but company-specific factors, it should be growing. It should not be, the growth rate should not be de-accelerating. ROE and ROC, I keep on repeating because that is one of our biggest sort of factors we track. Market share, what are the revenue contributors? What are the factors impacting margins, both positive, negative? Are you playing tactically for the next 2, 3 quarters, or are you playing it from a long-term strategic holding? And valuations, obviously, how are the current valuations compared to the peer group, compared to their own historic valuations? And I mentioned earlier, the quality of management. Some of the qualitative factors, again, it boils down to the management perspective. There are some management who are also quite keen to ensure that their stocks are trading at the valuation it deserves. Some management are indifferent. Obviously, one has to be very clear there. What are the reasons why you would want to own the stock? Will the stock become an institutional stock at some point of time, which I mentioned earlier, the small cap becoming large cap, and therefore who will buy when the stock increases? Market perception, which is the P, and eventually, will there be interest from big guys, whether they are mutual funds or FIs, to come into it? This is very, very simple. Why trust a professional management fund manager? I will not touch too much upon this, but with this, I come to the end of my presentation. Very happy to answer any questions at this point of time. We have roughly 15 minutes, so more than happy
Yes.
to take a question at this point of time.
So there are few questions. So Nishant Joglekar asks, any particular factor or observation that makes a maybe stock into hard number, something like that. Hard no. So am I audible?
Yeah, can you come again?
Mr. Nishant Joglekar, he asks, any particular factor or observation that makes a maybe stock into a hard no.
So I think when I say that these are the factors we should look at, I think the reverse is true, right? So when I mentioned to you what we should not be doing, so one is a fractured balance sheet. If the balance sheet is beyond repair, I think it's a clear no. If the history of the management is to do, not clean things in the past, it's a clear no. See, as traders, we want action. And more often than not, dicey management or dicey companies are the one which retail investors fall for. So for one Suzlon which would have done well, they will fall into so many other companies which are 2 rupees, 5 rupees, just because there is a story going on. So I think whatever is not a yes is a no, frankly.
Okay. Sandeep Kandhari, he asks that IPOs are for listing day gains, though staying investing brings companies. He's quoted some companies which I'm not naming. What is your view on taking listing day gains?
See, again, it is dependent on what you are looking at, right? If you are a trader, then you can do this. But at some point of time, you will get stuck because not all companies will have listing gains. Our view is that whether it is an IPO or a listed company, we always look at investing from a 3 to 5 years perspective. So as an investor, if you're a trader, then you can do this listing place. As an investor, we don't go for it.
Okay. So Jagrut Nimare asks, What exit criteria should be followed? How long do I hold if my thesis is correct or not?
So we have three main criteria of when we sell a stock. One is if the hypothesis based on what we have invested in the stock is not coming right. So you expected the company to grow, you expected the sector to have something, and that is not coming right. So you exit. Second is if the stock has run far beyond your expectations based on fundamentals. Then it doesn't make sense to hold on to it because you have made more than what you had expected. And third is capital is limited for everyone. So if you come across something which is better than what you already have, then obviously you would want to switch. So these are the three main criteria we use to sell stocks.
Okay. So Sandeep Kandhari asks, with coming of asset class specialized investment fund, how would it affect PMS?
I think every asset class is a good addition. So there will be certain advantages which an SIF has, and there will be certain advantages which a PMS would have. So obviously SIF is good for people with 10 lakhs and above. PMS is more for 50 lakhs and above. SIF predominantly strategies would be more on the long short side. PMS is more on the long only side. So I think they will coexist.
Okay. Vishal N asks, any specific screener query that retail investors can use for starting point, maybe for bottom up approach?
So I mentioned to you, start with the return on capital employed, return on capital equity, then zero down on growth of profit, and then look at valuation. I think if you do a combination of these three, probability of you losing money will reduce significantly.
Vicky Sanglikar asks, how to judge management quality or integrity?
I think it's a function of tracking the management and the company for a period of time. Reading balance sheets. I mentioned to you return on capital employed. Like again, stressing cash flow. Again, I'm stressing. How they have behaved in good times and bad times. In good times, everyone is good, but in bad times, if people are good, then they're actually genuinely good. So I think that will come with experience.
Okay. Prajwal Uchal has just written what return is targeted. That's it.
I think our return expectations from the next 3-5 years perspective is more like 14-15% CAGR.
Okay. Then there is a remark by Prajwal Uchal that quality factor did not perform in 25. And one person asked, what are your top 1 to 2 pieces of practical advice for someone completely new to stocks or mutual funds in their first year? Are there any specific habits they should develop or common mistakes they should avoid from day one?
I think habits, one is reading. Obviously, one has to read. Second is obviously, keeping aware of macro and micro factors. Third, obviously, is try and develop the habit of reading research reports and even balance sheets. And I would say fourth is create a model portfolio based on certain fundamental parameters and track how the portfolio is doing. So if it is doing good, why is it doing good? If it is not doing good, why it is not doing good? And I think that would be the best learning. And nowadays, content is available in plenty. So, there is more than enough to read and watch and everything.
Uh, Ravi Ranjan asks, what is your opinion on the formation of an AI bubble and its impact on the Indian markets? Where can we see the market in the next 2 to 3 years?
I think AI is here to stay. Anything which comes new, we always believe it's a bubble. I think when .com came, we believed it was a bubble and the stocks prices corrected also. But now if you see, we can't live without it. Same is the case with computerization. I think we basically are now used to computerization. Earlier, when computerization was introduced, government employees, in fact, went on a strike. So AI is here to stay. I don't know near-term stock prices of AI companies, but it is here to stay. As far as India is concerned, we will also embrace it. We are already embracing it. I don't think there is going to be any negative impact of AI on Indian stock markets.
So then Dipankar Bish asks that you mentioned about mean reversion in the lecture. If market revert to fair value over time, why do certain bubbles, specifically in AI, sustain high valuations for long periods before correcting?
Again, I don't believe that AI is a bubble, so I don't agree with it. The other thing is reversion definitely happens. Some reversion happens in 6 months, some takes 3, 4 years, but mean will always revert.
Is there a ratio to check moat of a company, or what are the factors to check or to identify the moat? Is what Amit Sahe is asking.
I think I explained that in great detail when I was presenting.
Okay, sir. Then Sakshi Garg asks, is there any way to check our entry time is good or not?
See, if you are a long-term investor, it doesn't matter at all. So any time is a good entry point.
Trai Tanu Singh says Ashwath Damodharan stated that most of the valuations are biased. Should we still trust the valuation? If you wish to take, sir, it's okay. And
Frankly, don't know. I think every market participant has a right to have his or her view.
okay. Then how to identify quality IPOs, especially new age companies? Satyanarayan Gandur asks this.
See, we are very value conscious. So, I don't think I am the right person to answer that because we are very, very value conscious. And most of the IPOs coming in are coming at very, very high prices.
Okay. Then one person has asked, anonymous attendee, what would be the abacus strategy apart from above while investing in IPOs?
No, so we selectively participate in IPOs, but we are very selective. So we like, even in the new age companies, we do invest, but only in profit-making companies. Our view is that we are investing in listed space and we would like to invest in companies and give them capital to grow, not to burn. So that is the main criteria we follow.
Okay. There are few questions on AI which Sir has already answered, so I am not repeating those questions. Broadly, the answer is the same. Then Dipankar Bish asks, how useful is the PE ratios in today's market environment? Many companies continue to trade at significantly higher PE multiples than their peers, yet their stock prices keep
Yeah.
rising.
So P multiples are a useful indicator, very simple, but not the only indicator. P multiples have to be seen in sync with the future growth potential. If the future growth potential is high, then the P multiples will always be high. So I think you can take PEG, which is the PEG ratio, which is more useful. So which is P divided by growth. I think if the growth is 20%, you can technically have a P ratio of 20, 25, 30 times also. So the PEG ratio has to be around 1.5 maximum. That is what a thumb rule kind of a thing is there.
Mohammad Farhan asks, is it advisable to invest in such companies having great growth in recent years, but management or leadership is not transparent or maybe looking unethical or controversial in some reports?
We will not.
Then there's again a question of one or two pieces of practical advice on stocks mutual funds. So, Sir has already answered this. I'm not taking this question again.
Can we take another 2, 3 questions at max now?
Yes. Another thing is, so I'll just select few of them then. There's many. Is there a good strategy to go for sound new age companies, even if they are not performing on the day of listing?
I think listing price should not matter too much if you're a long-term investor. So there are some companies which obviously list with a pop. There are some companies which list at issue price. Maybe you get an opportunity to buy it slightly lower also. So I think you should base your decision on fundamentals rather than whether the issue price was higher or lower.
Deepen Rajgopal asks how frequent the valuations of companies change.
Every minute, because price changes every minute.
And after taking 3 to 5 year investing horizon, even after good fundamentals and profitability, many of the stocks, many of the stocks are not much profitable or loss making. What's your view?
I didn't understand it. The profit growth is good, then why will it be loss making?
So this you can. So that is it, sir, from our
Thanks a
side.
lot. Really appreciate and very, very enthused by the excellent response. So many questions. I'm sorry if I have not been able to answer all your questions, but it was a great 1 hour session. At least from my side, I enjoyed it. And hopefully, we will do one again.
Yes, sure, sir. We also at NISM extend our sincere thanks to Mr. Sunil Singhania for taking out the time to speak today at our investor education webinar. Sir, your insights and expertise added immense value to the session. And we are also very thankful to all the participants for joining today's session. Your engagement has made the session truly meaningful. Thanks, everyone. Thanks again.